Welcome to SpikeAlerts.com. My name is Chris Vermeulen, the founder and creator of the Spike Alert system. And I want to quickly tell you about the benefits that you'll get from the Spike Alert strategy and alert service because it really is mind-blowing. This one little trick and this one little tick that can happen almost every day or at least once a week can make a lot of money over the course of a year. So let me tell you about the benefits really quickly, and then I'll get into explaining exactly how to read them, how to trade them, where to put your stops, how and when to take profits. So the nice thing about Spike Alerts is that we usually get weekly setups, usually get multiple Spike Alerts throughout the week. So you have a steady stream of income or trade ideas that you can trade at any time. Now, the nice thing about spike alerts is they happen in pre-market or they're end of day. We don't use any intraday, regular trading hours, price data. It's all pre and post market because we want to see when spikes happen where key support and resistance levels are and where the computers, the market makers, are going to try to run or walk the market in the next 48 hours. So if you work a full-time job or you're really busy throughout the day, the nice thing is these alerts happen hours before the market opens and after the market closes, so you've got lots of time to prepare for the next trading session. Now, spike alerts work with any asset type. This is what makes it really amazing. It doesn't matter if you trade ETFs, high beta stocks, options, futures, if you're spread betting, CFDs, or even binary options. It doesn't matter what you trade as long as it mirrors the index that the spike is on, you can trade it. Whatever you're comfortable with is what you can trade. Now, our streaming data servers, we monitor 5 markets: the SP 500, the Nasdaq, the Russell 2000, gold, and the gold miners index. So each alert that is sent to you is just like the one you see on the screen here today. This is a screenshot of an actual trade alert of the Nasdaq. You can see at the top it says new spike of 0.8% to the 109.94, which is this level here on the market. So the market is trading down here and we have a spike up to this area. So this is our spike target price. That's where we expect price to go. It's 0.8%, so that's a pretty decent move in the market. If it was to go up and fill, you can make some pretty decent money in a very short period of time. So let me just kind of walk you through what we can trade here. Now, in every alert, we provide this little table at the bottom, giving you the 3 most popular options, the easiest ones to trade for the market. Now, right now, this is a long trade, so the market we expect to move up. So we are using the 3 times leveraged long ETF, also the 2 times leveraged long, and a futures contract if you wanted to trade it. And it shows you with the leverage the potential profit that could be made when that spike is filled. Obviously, futures has got a lot more leverage than an ETF, so there's a lot more profit potential, and you really only have to invest a lot less capital. One futures contract is much lower than what you'd require to trade an ETF to make this amount of money. Now, all these alerts are based on a $10,000 play investment on that ETF or one futures contract. Futures contracts vary. Obviously, if it's an intraday, you can trade a futures contract with as little as $500 per contract. So you could see technically you risk $500 and potentially make almost 140% return on your money in one day. Some brokerage firms, intraday is more or less the $2,400 level. Either way, you require a lot less capital with a lot more leverage and upside potential using futures. So now let me just quickly walk you through how to trade spike alerts because it is part art and part science, and it'll take a little bit of getting used to. But once you understand these core rules and the way the market works with these, it'll become very simple for you to follow and trade on your own. So starting off, again, alerts happen in pre or post market, not intraday. So you've got lots of time to prepare when an alert pops into your inbox. You've got all night or you've got an hour or 2 in the morning to prepare for an ETF or a futures trade going forward. Now, the spike alerts typically tell us the direction the market's going to go that day or the following day. The market makers can manipulate and walk the market where they want to a certain extent, as long as volume or there isn't huge movement in the market that can counter it. A light volume day, they are actually able to walk the market around and get to these levels fairly easy. During high volatility and during big news events, they're not going to be able to walk the market if the market is moving it the other way. There's too many people fighting it. But on a lower volume day, these spike alerts can happen and be filled fairly easy and sometimes go well beyond those spike levels. The other nice thing about knowing where the market is likely to head, which is this current spike alert is likely to go higher, if you do have any other positions in your portfolio, it's a great insight for you to know whether you should be looking to either tighten a stop on a position, look to take some profits when that spike level is reached, or to potentially exit a position if you're actually in the opposite direction with another trade. You don't want the market to go up, but our spike alert shows the market is likely to rally. You may want to exit that play and actually take advantage of the spike direction, and then you could re-enter that short that you had originally at a much better price. The other thing is you can always take partial profits, and there's a lot to how you want to trade this. And the key here is to take partial profits when certain levels of the spike alert price is reached. For example, let's just go over here. So we had a couple spike alerts. Now keep in mind these blue bars, these sections here, this is pre-market, this is post-market trading, pre-market, post-market, pre-market. During the blue times is when the spike alerts we're looking for, when the market tips its hand and says this is where we are looking to walk the market in the next 48 hours. During regular trading hours, which are these middle white sections, we're not using any spike data if there are any spikes for our potential setups. Now, what the market is going to try and do is for entering a position, when we get a spike alert, you usually want to enter at the spike alert. You want to get a position in play. A lot of times we will see the market just kind of make that spike and then go and move. But believe it or not, a lot more times we actually see the market try to do what I call is a squeeze in reverse, which means we know the market is likely to head higher, but the market is going to try to run and squeeze everybody out, make new lows. 9:30 the market opens, it makes a new low, gets everybody off the wagon and thinking the market's going to sell off for the day, and then it reverses and rallies. So it squeezes out the longs and then reverses to fill that. And of course it ended up going on to make massive gains for that trading session. So what you want to do is scale into a position. You can get partial position at the alert, and if the market squeezes down a substantial amount to 25 or 50% of the spike amount to the downside against the play, you can add the second half, getting you in at a nice average price before the market takes off. And the nice thing about it is the way we put our stops in place is we never want to risk more than the spike alert distance. So for example, if we have a spike alert, this is the amount of risk we have that we're going to use to the downside. So if we're going to risk potentially $239 on the trade, we would move that down $239 and say, well, if the market moves below that level, I'll get stopped out. And what we want to do is take partial profits when the market starts to move in our favor. So as the market moves in our favor and say 30 or 50% of that spike price has been filled, market starts to move up, we fill, say, 30% of that spike price, we may want to take some money off the table, lock in a little bit of profit, and we want to move our stop to break even. It's all about eliminating risk as soon as possible. Now, you don't have to take profits there, but you definitely should be moving your stop up. And as the market rallies up to 50%, 80%, or 100%, you want to be looking to either close the position out and lock in profits, or choke out your trade with a very tight stop using a previous candle bar's low until eventually you get choked out of the trade with a profit. It's all about when the market starts to move in your favor, reduce risk by raising your stop, take partial profits, and look for that quick. We're looking for these one base hits repeatedly throughout the week. So let me just show you the reverse and squeeze again. So here we had a spike alert which would have hit our minimum level. The market tried to squeeze everybody out first before it rallied and filled that spike. Over here, we had a big spike to the downside. What did the market do? In overnight trading, it went up. It tried to squeeze out everybody who saw this, or trying to squeeze out the shorts. And then, of course, the market sold off and came down and filled that spike the very next morning before noon. Over here, we have another spike. We had a couple spikes happen right up to this level. And I'll show this chart in just a moment, but I'll draw on what happened. So knowing the market typically does a squeeze and reverse, the market's set to go higher, but they're going to try to get everybody out, get everybody to sell their positions. The market will accumulate a long position. All the shares, as everybody piles out, they'll accumulate a long position. So we're expecting a squeeze and then a reverse. And what the market did was it went up and filled 50% of this the very following session, or this exact same session, which is a level that you should have been taking partial profits or tightening your stop. And then it actually came back down later in that session, hit that, tested that low for a double bottom, and then eventually it rallied all the way up and filled this full spike. So either way, you would have been taking partial profits at that 50% level with a break-even stop on the balance, where you would have got stopped out somewhere over here, having a nice little gain. And then we actually had another spike up right over here, actually, that took place, and the market continued to rally up and filled that one also, a much larger spike. So let me just pull that up real quick here. So here is the chart. It's a little big. It's a 30-minute chart, exact same day time frame, and this is what we're looking for. Overall, we had a spike down on the chart over here the previous session. The market squeezed up overnight, as I showed you, and then it came down and filled that spike. Now, once that took place, we ended up seeing the market. This doesn't really show the pre and post market, but you can see we had a spike over here and a spike over here. This was in pre-market. This here is in post-market. Happened just before the open, and another one happened just after the close. So the market opened here, and we saw the market do a little squeeze, and then it reversed up, filled more than 50% of that price spike, which is what we're looking for. Anything above 30%, we're starting to put our stop to break even and looking to lock in partial profits. And so we had a little winner there. The following session, after the market closed, we had another spike up. And of course, the market opened the next day and rallied and ripped all the way to the upside and really doubled that. It almost had a 200% move on that spike for that day, but you can see how that played out. Now, another play, you can see here how the spikes just continue to unfold. In post-market trading later that session, we had a spike down, and the market in overnight trading and the following session came down, filled that spike, and just kept on tumbling and sold all the way back down. Obviously, this small little spike, that was a 300 or 400 per times the spike move, but it just goes to show how powerful some of these are. They signal some key reversal points in the market. And then later that session, after the market closed, we saw another spike to the upside. And what did the market do? It tried to squeeze down in overnight trading. And then by the time the market opened the next morning, it was already a huge move up, blowing way past that 30, 50, 80% level, and then it reversed back down. But you can see how this just continues to play out, these spikes over and over again. Some weeks we'll have 5, 6, 7 spikes. Other weeks we might have one or none. It really depends on the market, the volatility, what's going on, but these are a steady stream, typically week after week, month after month. And I've been following these since 2010 and sharing them publicly on my blog. And it's time, I think, that more of us start to trade it together, because it is amazing, it's fun, and it's very active if you want to be very active in the market. The last thing I'd like to show you here is just the Spike Alerts members area. Once you subscribe to the service, you'll be taken directly to your profile page where you'll have your active subscriptions, and you'll have an enter button beside Spike Alerts. You simply click the enter button or the Spike Alert link, and it'll bring you to the members area. Here we explain briefly about the Spike Alerts, and you can see the previous spikes that have happened over the last week. Also, you'll have this video you're watching is in here, so you can rewatch it, understand how to use stops, price targets, scale in and out of positions. Very simple stuff, but make sure you watch this video a couple times so it really sinks in. It's easy to skip or miss something that I said. There is a lot of information about how to trade these price spikes properly. I kind of go through it fairly quickly, so make sure you watch this at least twice to get the hang of it. And last but not least, hopefully you enjoy what you see here and share with any insight and feedback that you have. Thanks very much. Bye-bye.